This week in the economy, job numbers, tariffs, and interest rates. This week, the economic landscape presents a rather concerning picture. The number of new jobs created is disappointingly low, tariffs are on the rise, and interest rates remain unchanged. For those interested, you can listen to the full discussion here. ondemand.npr.org, anon.npr mamp3, NPR, Wesson, 2025-08, 2025-083, Wesson. The economy this week, new jobs are low, tariffs are up, and interest rates hold. MP3, T Progseg, ENX S1547271 P10, Seg 8, D352, SARS 5639568, SC Site Player AW0, 1 First Player ID Site Player. Additionally, you can find the embedded audio player below. In a recent conversation, NPR's Ayesha Rascoe engaged with Mary Lovely from the Peterson Institute for International Economics to delve into the current state of the U.S. economy. They discuss the implications of the latest trade agreements introduced by the Trump administration, which have stirred quite a debate among economists and policymakers alike. But here's where it gets controversial. While some argue that these tariffs are necessary to protect American jobs, others believe they could lead to higher prices for consumers and strained international relations. What do you think? Are tariffs a necessary evil in today's economy? Or do they do more harm than good? Share your thoughts in the comments below. 2025 U.S. Economy Update. Inflation, Tariffs, and Job Market Trends Explained. Feeling overwhelmed by the state of the economy? You're definitely not the only one. With all the buzz about inflation, trade policies, Federal Reserve decisions, and job markets, it's no wonder many people are scratching their heads trying to make sense of where the U.S. economy is headed. But here's the thing. This past week delivered a flood of economic updates that, while still somewhat murky, offered a clearer glimpse into the current state of affairs. So, what does it all mean for you? Let's break it down. If you're looking for the quick summary, here's what you need to know. The U.S. economy is, while Trump's trade deals might open doors for American goods in foreign markets, Americans are now paying more for imported products due to increased taxes. Meanwhile, the once dependable job market is showing cracks, with hiring slowing down more than anticipated. And as for interest rates, well, that long-awaited cut might not be too far off. Want the full story? Here's where things get interesting, and maybe a little controversial. When Trump rolled out his ambitious trade agenda, many braced for economic chaos. Surprisingly, or perhaps not, that hasn't happened, at least not yet. Instead, the absence of an immediate recession has bolstered investor confidence, pushing stock markets to record highs recently. Emboldened by this stability, Trump decided to ramp up tariffs significantly in a recent announcement. As a result, America's effective tax rate on imports has skyrocketed from just 1.2% last year to over 18%. According to Yale's Budget Lab, this could cost the average household an extra $2,400 annually. But here's where it gets tricky. While the economy has proven remarkably resilient so far, experts warn that the true impact of these tariffs is only beginning to surface. By the second half of 2025, we may see even greater ripple effects. For instance, June saw a noticeable uptick in prices for certain goods impacted by tariffs, which contributed to a rise in overall inflation. The Personal Consumption Expenditures, PCE Price Index, a key measure favored by the Federal Reserve, showed a 0.3% monthly increase, bumping the annual inflation rate to 2.6%, its highest level in 4 months. This trend moves further away from the Fed's target of 2% inflation and hints at potential trouble ahead if prices keep climbing. Now, let's talk jobs. However, July's employment numbers are weaker than expected, and revisions to May and June figures painted an even bleaker picture. In fact, the average number of jobs added per month through July stands at just 85,000, a figure that falls short of what's needed to maintain steady unemployment rates. outside of the pandemic year of 2020, this marks the weakest start to a year since 2010, when the nation was recovering from the Great Recession. So, how are consumers holding up amidst all this? Despite rising costs for items like appliances, furniture, clothing, and toys, spending remains relatively stable. For now, a segment of the population has benefited from gains in the stock market, thanks to improved clarity on tariff rates, boosting investor sentiment. However, wage growth, though still outpacing inflation, isn't keeping up as robustly as in previous years. Data released Thursday highlighted modest increases in consumer spending, with expenditures rising 0.3% in June compared to May, or 0.1% after adjusting for inflation. These are small wins, but they suggest that households are managing, for the moment. Consumers can handle this, said Gus Focher, chief economist at PNC Financial Services, in a conversation with CNN. But consumer psychology is unpredictable. While the data doesn't point to an imminent recession, it does reveal vulnerabilities. If something else goes wrong, the economy could tip into a downturn. And then there's the Federal Reserve, caught in the crosshairs of political pressure and economic responsibility. At the end of a two-day policy meeting, Fed Chair Jerome Powell maintained high interest rates despite criticism from Trump, who claims these rates are hurting mortgage accessibility. Interestingly, while the Fed influences loan rates, it doesn't directly control them. That's the domain of the bond market. Ironically, Trump's own policies, including massive domestic spending and relentless attacks on Powell, have made bonds less appealing to investors, contributing to elevated mortgage rates. Will he get his wish for a rate cut soon? Possibly. After Friday's disappointing jobs report, expectations for a September rate reduction surged. Finally, let's touch on GDP, the broadest measure of economic health. Preliminary data shows a solid 3% annualized growth rate for the second quarter, driven largely by rebounding consumer spending. Sounds great, right? Not so fast. Digging deeper reveals that tariffs have distorted the numbers. In Q1, importers rushed to stockpile goods ahead of tariff deadlines, artificially inflating the trade deficit and making the economy seem weaker than it was. Then, in Q2, imports dropped sharply as companies sold off inventory, narrowing the trade gap and creating the illusion of strength. The reality lies somewhere in between. The economy is still chugging along but losing steam. So, what's the takeaway? The blizzard of economic updates this week largely aligned with forecasts, with one glaring exception: jobs. Overall, the economy appears to be muddling through, but with growing concerns about trade imbalances and weakening employment trends. The developments of this week depict an economy that's slowing and will likely continue to decelerate. Gregory Dacko, chief economist at EY Parthenon, told CNN, while he doesn't see an immediate recession on the horizon, weak job growth, combined with ongoing supply chain disruptions, raises risks. This erosion of momentum leaves the economy exposed to potential shocks. What do you think? Is the economy stronger or weaker than it seems? Share your thoughts in the comments below.